Now we're going to shift gears and talk about something absolutely critical for your success as a volume profile trader: adapting your strategy to the specific trading session you're working in. This is where a lot of traders go wrong. They develop a strategy that works during New York hours, and then they try to apply that exact same approach to the London session or the Asian overnight session, and they get frustrated when it doesn't work. Here's the truth. Each trading session has its own unique characteristics, volume patterns, and behavioral tendencies. If you want to maximize your edge, you need to tailor your approach to match the session you're trading. Let me walk you through the three major trading sessions: London, New York, and Asian/overnight. We'll cover the characteristics of each session, the optimal approach for that time window, and what you need to watch out for. London session, 3 a.m. to 9:30 a.m. Eastern Time. Let's start with the London session. This is the early morning window for US-based traders, running from 3 a.m. to 9:30 a.m. Eastern Time. London overlaps with European trading hours, and it's when major institutional participants in Europe are active. Characteristics of the London session. First, it builds momentum after 3 a.m. New York time. The first hour or two can be slow, especially from about 2 a.m. to 3 a.m. when you're transitioning out of the Asian session and into London. But once 3 a.m. hits, you start to see real participation and directional moves develop. This is when European traders are fully engaged and you get cleaner price action. Second, London trends are cleaner than the Asian session. Compared to the overnight Asian hours, London gives you more directional moves and less choppy, range-bound behavior. You're not dealing with the same degree of whipsaw that you might see during the low-volume Asian hours. Trends develop more reliably, and when you get momentum, it tends to follow through. Next, there's good respect of previous day levels. London traders pay attention to yesterday's value area high, value area low, and point of control. These levels act as magnets and reference points. When price approaches PDVAH or PDVAL during London, you often see clear reactions, either rejections or acceptance, which gives you tradable setups. Moreover, you get moderate volatility with steady participation. It's not as explosive as New York can be, but it's not as sleepy as the Asian session either. You have enough movement to capture meaningful profit targets, but the pace is manageable. You're not dealing with the same kind of institutional firepower that hits during New York hours, so the moves are more measured and predictable. Approach for the London session. Here's how you want to trade London. First, favor previous day VAH or VAL fades with trend confirmation. This means if price approaches PDVAH and you're in a bearish trend on your 1-minute chart, you're looking to fade that level, short from resistance. If price approaches PDVAL and you're in a bullish trend, you're looking to buy from support. The key here is trend confirmation. Don't fade levels counter-trend during London. Wait for your 1-minute trend to align with the direction you want to trade. Avoid the 2 a.m. to 3 a.m. transition period if it's choppy. This is the handoff from Asian to London hours, and it can be messy. If you see price whipping back and forth with no clear direction, just stand aside. Wait until after 3 a.m. when London participation picks up and the noise settles down. Finally, look for B setups turning into A setups post 3 a.m. What does this mean? You might identify a B-grade setup at 2:30 a.m. Maybe price is near PDVAL, but your trend isn't aligned yet, or you don't have a strong rejection candle. That's a B setup, valid level, but you're waiting for confirmation. Then at 3:15 a.m., after London liquidity arrives, your trend shifts bullish and you get a strong rejection wick off PDVAL. Now it's an A setup. The session transition can upgrade your setup quality, so be patient and wait for that confirmation. Now let's talk about the New York session, which is the primary trading window for most volume profile traders. This is regular trading hours, or RTH, running from 9:30 a.m. to 4 p.m. Eastern Time. This is when U.S. equities markets are open, and you get the highest volume and liquidity of any session. First, this is where you see the highest volume and liquidity. More participants, more institutional money, more retail traders. Everyone is active during New York hours. This is the deepest, most liquid market environment you'll trade in. That's both an advantage and a challenge. The advantage is that your setups have strong follow-through potential because there's real buying and selling power behind the moves. The challenge is that with so much volume, you also get more noise and complexity. Second, the period from 9:30 a.m. to 10 a.m. is often chaotic and irrational. The market open is notorious for wild price swings, gap fills, and unpredictable behavior. Algos are running, retail traders are piling in based on overnight news, and institutional orders are hitting the tape all at once. Unless you're an extremely experienced scalper who thrives in chaos, I strongly recommend you avoid trading the first 30 minutes of the New York session. It's just not worth the risk. You're more likely to get chopped up than to catch a clean move. Third, post 10 a.m., structured moves develop. Once that initial chaos settles down, usually around 10 a.m. or 10:15 a.m., the market starts to show its hand. You'll see whether it's a trending day or a range day. Volume profile levels start to get respected and price action becomes more readable. This is when your A-grade setups appear. From 10 a.m. onward, you're trading in a much more structured environment where your edge actually works. Fourth, there are strong reactions at previous day levels. New York traders absolutely respect PDVAH, PDVAL, and PDPOC. These levels are watched by everyone: institutions, hedge funds, proprietary trading firms, and retail traders. When price approaches these levels during New York hours, you get clear, decisive reactions. Either price rejects hard or it breaks through and holds. Either way, you get tradable opportunities with high conviction. Here's your playbook for New York. First, wait until after 10 a.m. for quality A setups. I can't emphasize this enough. Don't trade the open. Wait. Be patient. Let the market show you its structure. After 10 a.m., you'll have much higher probability setups because the noise has cleared and the real participants are driving price. Second, trade ranges around POC and fade VAH or VAL extremes. During New York, you often see price oscillating between the point of control and the value area extremes. If price is near POC and trending, you can trade continuation setups, buying support at POC in an uptrend or selling resistance at POC in a downtrend. If price reaches VAH and shows rejection, you fade it, short from the top of the value area, targeting back down to POC. If price reaches VAL and shows acceptance, you're looking to buy the support, targeting back up to POC. New York is excellent for range trading because the volume is thick enough to support these oscillations. Third, consider standing down during earnings or major news events. If there's a Fed announcement, FOMC meeting, CPI data release, or major earnings report for a heavily weighted stock in the index you're trading, think twice about trading that session. These events can override all your technical levels and create violent, unpredictable moves. It's okay to sit out. Protect your capital. There will be another trading day tomorrow. Continue to Part 3 for the Asian overnight session and summary.
Finally, let's talk about the Asian overnight session, which spans from 6 p.m. to 9:30 a.m. Eastern Time. This is the longest time window, starting when U.S. markets close and extending until New York opens the next morning. It includes Asian market hours, Tokyo, Hong Kong, Singapore, and the tail end of European hours. This period is often referred to as the overnight session or Globex hours by U.S.-based traders. First, you'll encounter lower volatility in volume compared to New York or London sessions. Asian markets don't have the same depth of liquidity as U.S. or European markets, leading to smaller moves and tighter ranges with fewer participants. This requires adjusted expectations and approach. Second, Asian traders pay close attention to prior day and prior week levels like PD-VAC, PD-VAL, PD-POC, PW-VAC, and PW-VAL, which act as strong magnets and boundaries due to lower volume. Price often rebounds off these levels during Asian hours. Third, range behavior is prevalent. Instead of trending moves, expect prices to oscillate between support and resistance within a set range. This is great for scalpers preferring quick trades or swing traders building positions for the New York session. Fourth, and importantly, see Slide 23 for detailed trading windows. The Asian overnight session shouldn't be treated as one uniform block, but as three distinct windows: evening, late night, and pre-market. Each has its characteristics and approaches, covered in detail on Slide 23. Approach for the Asian overnight session. Adapt your strategy for these hours. Reduce your position size due to lower participation. Scale 30 to 50% smaller than New York hours to manage risk. Target closer structures instead of distant levels, making sure not to be greedy. Profits should be taken at the first logical points. Use the overnight profile for discovering magnet levels like overnight POC, VAC, and VAL. Summary: adapt your strategy, position sizing, and profit targets to each session's rhythm. Don't trade London like New York or Asian hours like London. Professional traders adjust their strategies according to each session's unique characteristics, while amateurs force strategies across sessions and lose money. Next, we'll dive deeper into the New York session playbook to explore navigating the highest volume window of the trading day with specific timing strategies and setup examples for optimal execution.
Let's dive into the New York session playbook, your primary trading window and the most important session you'll trade as a volume profile trader. The New York session runs from 9:30 a.m. to 4 p.m. Eastern Time. This is where you'll find the highest quality A-grade setups with maximum liquidity, institutional participation, and the cleanest reactions at volume profile levels. Why is the New York session so critical? Because this is when the market has maximum participation. U.S. institutions are actively trading. Algorithmic systems are fully engaged. Volume is at its peak. Importantly, the previous day's levels, the VAH, VAL, and POC, are respected with the highest degree of reliability during this window. When you see price approach a PD-VAL during the New York session, you can have significantly more confidence that it will react compared to the same level being tested during the overnight or Asian session. Let's break down the characteristics, the approach, and then I'll give you a critical homework assignment to cement your understanding. Characteristic number 1, highest volume and liquidity of all sessions. This is non-negotiable. The New York session sees more contracts traded, tighter bid-ask spreads, and faster order execution than any other time window. For ES futures, you might see 8,000 to 15,000 contracts trading on a single 1-minute candle during the New York session, compared to 1,500 to 3,000 contracts during the overnight session. This massive volume creates cleaner price action because there are enough participants to push price decisively in one direction or another. False moves are less common because the market has consensus. Characteristic number 2, the first 30 minutes from 9:30 a.m. to 10 a.m. are often chaotic and irrational. This is the gap fill period, the overnight reaction period, and the time when retail traders scramble to react to news or overnight moves. You'll see erratic candles, fake breakouts, and stop hunts. Professional traders stand aside during this window due to unpredictable behavior. During this time, the market processes overnight information, digests any news that dropped before the open, and absorbs order flow from traders who are waiting for the liquid session to begin. Characteristic number 3, post 10 a.m. structured moves develop with clearer trends. After the morning chaos settles, the market often transitions into a more predictable rhythm.
This is when clean consolidations followed by breakouts, POC-centered ranges with clear bounces at the VAH and VAL, or decisive trend days where price moves in one direction with pullbacks to key levels appear. The post-10 a.m. window is your golden hour because this is when A-grade setups appear with the highest frequency and the best follow-through. Characteristic number 4. Strong reactions at previous day levels. During the New York session, the PDVAH, PDVAL, and PDPOC act as magnets and barriers with incredible reliability. Institutional algorithms reference these levels extensively. Large funds use volume profile as a core component of their execution strategies. When price approaches a PD level during the New York session, you're not just trading against retail participants, you're aligned with the same levels that billion-dollar institutional flows are watching. Institutional algorithms are most active during regular trading hours. The algorithms that drive the majority of market volume operate during RTH, that's 9:30 a.m. to 4 p.m. Eastern. These systems fade extremes, buy dips, sell rallies, and execute massive orders without moving the market too much. As a volume profile trader, you benefit from this. Institutional behavior creates the patterns you're trading. Ranges around the POC, bounces at the VAH and VAL, and mean reversion after overextensions. The volume profile levels you use were created by previous days' institutional activity, and these institutions reference those levels the next day. Let's talk about your approach, how to actually trade the New York session using volume profile principles. Strategy number 1. Wait until after 10 a.m. for quality A-grade setups. The first 30 minutes are a trap for inexperienced traders. The volatility is chaotic, not structured. Structured moves appear after 10 a.m. when the chaos settles. Waiting often leads to consistent profitability. Strategy number 2. Trade ranges around the POC and fade extremes at the VAH and VAL. During the New York session, the market frequently operates in balance. Price oscillates around the point of control, creating a mean reversion environment. This range trading approach works beautifully in balanced conditions. Strategy number 3. A-grade setups at previous day levels work best due to high confluence. When you combine a PD level with a lined trend structure and a rejection candle during the New York session, the trade setup offers exceptional reliability. Strategy number 4. Look for POC-centered ranges post 10 a.m. After morning chaos, price often settles into a range with the POC at the center. Draw your range boundaries, typically the overnight high and low. Buy near the bottom of the range, sell near the top, take profits quickly at the POC. Strategy number 5. Use tighter stops because liquidity allows precise entries. During the New York session, you can place stops closer to entry without worrying about thin liquidity impacting the trade adversely. Here's a critical warning. Avoid trading during earnings releases, FOMC announcements, or major economic data drops. On high-impact news days, consider reducing size or standing down entirely. Here's your homework assignment. Review charts from the past week during New York hours. Identify clear examples for each pattern described. Screenshot, annotate, and save to your trading journal. Task number 1. Find a range to trend example post 10 a.m. Task number 2. Find a POC bounces example. Task number 3. Find an overnight level rejection example. Active pattern recognition is essential for profitability. Next, we'll dive into the Asian and overnight session playbook, where you'll learn how to trade the 3 distinct windows within the overnight period.
Alright guys, so let me show you a quick example on how you can trade the New York session specifically. Now, in the future, I will be making more videos with way more examples, but I just wanted to quickly give you one example of how you can trade with the New York session. Now, real quick, nothing is set in stone, Okay, remember guys, I don't teach anything that I tell you this is the only way to trade. There are many ways to trade, so it's up to you guys on how you want to do your playbooks. Okay, but real quick, this example is actually really nice. So another thing you guys can do is also add previous week's value levels as well as the overnight sessions value levels in confluence with the previous day's value levels. Now remember guys, when I'm talking about previous days, I already explained this in the last video, I'm talking about the regular trading hours sessions levels. Now if you don't know what I'm talking about, you can either go on the Reddit page that I made explaining this, or you can also look at the previous video for more of a clearer explanation. I believe it's towards the end of the video. I'll try to link everything down in the description, guys, so check the description, please. I have so much good stuff in there. You guys are missing out. So for now, yeah, let's just stick with this. So some people might call this like a value breakaway. So when I say, or when you hear value breakaway, that usually means that price is breaking through a value area high or value area low, breaking away towards the upside. So instead of the value area high here, instead of being seen as a form of resistance, it turns into a form of support, right? Price breaks over it, retests it, and then goes back up. Usually when people talk about like a value fade or a value area fade, it's when price temporarily will do something like this. It'll go up, peak a little bit over it or a good bit, and then it'll come back down, right? Kind of showing some respect. And then same thing here, it'll also peak a little bit over the value area low, and then slowly start moving back up, showing that it was actually respecting it. So keep that in mind. I'm pretty sure I explained that in the previous video, and if I didn't, then well, here you go. So anyways, as you can see from the previous day's levels, price came down, right? Obviously it broke through, causing a breakaway from the previous day's value area high. Price came down, started retesting it, started moving back up. As soon as 10 a.m. hit, you would have seen this, guys. You would have noticed this kind of price action just off of the 1 minute time frame alone. Okay, I'm in the 1 minute time frame. You guys would have seen this and said, okay, clearly we're being bullish. Price is respecting the previous day value area high. Not only did it retest it, but we also have a order block here, right? So price broke through, took out some liquidity, did not reverse, right? Price came back, retested this order block. Price ended up breaking structure towards the upside. You guys could have re-entered there, or you could have entered into one of the fair value gaps. I would just highlight this whole fair value gap here. Let me zoom in. So as you can see, this whole gap here, right, from here to here. Once price came in, tapped into that fair value gap, and you see this nice bullish candle rejection. You could have entered here and either a stop loss at the fair value gap, or a stop loss at the previous day's value area high, or even slightly below it, or under some structure, right, that's near that previous day's value area high, or a little bit lower, right? It's up to you. But in this case, since we're clearly bullish, we're already moving really well, there's no reason to be super crazy about it. So I'm just going to put it like slightly under the fair value gap, and then I can just go for strict 2R, bam, TB hit. Okay, now again guys, check the description down below and keep your eyes peeled, because I will be making a couple of more different strategies talking about the volume profile levels. I'll probably end up making like a little strategy that you guys can follow in a Reddit post, so just check the description down below. All right, so let's move on.
Now we're diving into the Asian and overnight session playbook, which covers the extended period from 6 p.m. Eastern Time all the way through 9:30 a.m. the next morning. This is a long window, over 15 hours, and treating it as a single homogeneous session is a massive mistake that most retail traders make. The reality is that the overnight session has three distinct trading windows, each with completely different characteristics, volume profiles, and tactical approaches. Understanding these three windows is critical if you want to trade outside of regular trading hours. Many traders assume the overnight session is just dead time or that it behaves uniformly throughout. That's simply not true. There are specific periods when high-quality setups appear, and there are periods where you should absolutely not be trading unless you're extremely experienced and highly selective. Before I break down each window, I want to emphasize something important. What I'm about to share reflects my personal experience and what I've found to work best after years of trading these sessions. This is not a rigid rule book carved in stone. Volume profile trading, especially during lower liquidity sessions, requires discretion and adaptation. I strongly encourage you to explore these concepts, backtest them with your own data, and adjust the approach to fit your schedule, risk tolerance, and trading style. What works for me might need tweaking for you, and that's perfectly fine. The goal is to give you a framework, not a script. Let's start with window number 1, the early overnight session, which runs from 6:30 p.m. Eastern Time to 11 p.m. Eastern Time. First, a critical note. Between 6 p.m. and 6:30 p.m., you should wait. Do not trade. This 30-minute buffer is essential because the Globex session has just opened and the market is still processing the close of regular trading hours. You'll often see erratic moves, fake breakouts, and low-conviction price action as overnight participants digest what happened during the day session. Let the market settle and establish an opening range before you consider taking any trades. Now, once we're past 6:30 p.m. and into the early overnight window, here's the context you need to understand. This period coincides with the initial Globex reaction and the Tokyo market open. The Tokyo Stock Exchange opens at 9 p.m. Eastern Time, which falls right in the middle of this window, and that can bring a modest uptick in participation. The opening range that forms in the first 30 minutes of Globex, from 6 p.m. to 6:30 p.m., is fresh and tends to be respected by overnight traders. This is because it represents the first consensus of value after the RTH close. Volume during the early overnight window is moderate. It's not as thin as the deep Asian session, but it's nowhere near the liquidity of the New York session. You might see 2,000 to 4,000 contracts per minute on ES futures, compared to 8,000 to 15,000 during New York hours. This moderate volume means the market can still move with some conviction, but you need to be more cautious about entry timing and stop placement. Your approach during this window should be tactical and range-focused. After the first 30 minutes have printed and established the opening range, you're looking for one of two scenarios. Scenario 1, price breaks the opening range, either the high or the low, and holds beyond it. If this happens, you follow the breakout. You're trading the expansion, assuming that the overnight session is beginning with directional intent. Scenario 2, price tests the opening range high or low and gets rejected. In this case, you fade the extreme back toward the developing point of control, which is forming in real time as volume accumulates. Here's the key tactic for the early overnight window. Let the first 30 minutes print. Do not rush. Watch what the market does with the opening range. If price breaks the range and holds, meaning it closes beyond the opening high or low and stays there for at least 2 or 3 candles, you have permission to follow the breakout. You're trading with the early directional bias. But if price rejects the range high or low, perhaps with a strong wick, a reversal candle, or simply a failure to sustain the break, you fade it back toward the center. The center, in this case, is the developing point of control, which is your magnet during balanced overnight conditions. This window favors a patient, confirmation-based approach. You're not firing at levels aggressively like you would during the New York session. Instead, you're waiting for the market to show its hand. Does it want to break out, or does it want to rotate? Once you see clear evidence of one or the other, you act. This is classic B-grade setup territory. You need confirmation before entry because the lower liquidity means false moves are more common.
Welcome to part 2 of the Asian/overnight playbook, 3 trading windows.
Now, let's move to window number 2, the Deep Asian session, which runs from 11 p.m. to 3 a.m. Eastern Time. This is the lowest volume and liquidity period of the entire 24-hour trading cycle. During these hours, U.S. institutional participation is virtually non-existent. European markets haven't opened yet. Asian markets are active, but they don't drive significant volume in U.S. equity index futures. What you're left with is algorithmic activity, a handful of overnight retail traders, and very thin order books. Here's the context you need to understand for this window. Tight consolidation ranges are extremely common. The market often coils into a narrow band, sometimes just 5 to 10 points on ES, and chops around with no clear directional commitment. This is not trending behavior. This is waiting behavior. The market is biding time until the next major liquidity injection, which comes with the London Open at 3 a.m. You'll also see what I call algorithmic drift behavior. Price will slowly grind in one direction with small, methodical candles, not because of strong conviction, but because algorithms are managing overnight positions or executing large orders in tiny slices to avoid moving the market. This drift can look like a trend, but it's usually low conviction movement that reverses quickly when it hits a significant level. Given this context, your approach during the Deep Asian window should be highly selective. For most traders, this is an optional trading window, and it's often skipped entirely. There's no shame in standing aside during these hours. The risk-reward is generally poor because the tight ranges and low volume create choppy, unpredictable price action. You can get stopped out on a 2-tick move that means absolutely nothing in the grand scheme of the day. However, if you do choose to trade this window, perhaps because it fits your schedule or you've identified a specific opportunity, you should only take A-plus setups at major levels. What does that mean? It means you're looking for reactions at previous day VAH, previous day VAL, previous week POC, or other highly significant levels that the entire market watches. And even then, you're waiting for clear, strong rejection signals before entering. A single wick candle isn't enough. You want multiple confirmations, perhaps a rejection wick followed by a strong reversal candle, or a double test with clear volume stepping in to defend the level. Here's the key tactic for the Deep Asian window. Patience is critical. Avoid overtrading the chop. The worst thing you can do during this period is force trades just because you're sitting at your computer watching the market. Set alerts at major daily and weekly levels, PDVAH, PDVAL, PWPOC, PWVAH, PWVAL, and then ignore the noise in between. If price reaches one of those levels and you get an alert, then you watch closely for a high-quality rejection. But if price is just meandering around in the middle of the range with no clear catalyst, you do nothing. This is where discipline separates profitable overnight traders from those who bleed their accounts slowly. The temptation to trade during these quiet hours is strong, especially if you're awake and staring at the screen. But most of the movement during the Deep Asian session is meaningless. It's algorithmic noise, not actionable price discovery. Respect the low liquidity, protect your capital, and wait for the London Open, which brings real opportunity. Next, we'll explore the third trading window, the pre-market session, right before London opens, where actionable setup opportunities increase significantly. Let's explore window number 3, the London Open, running from 3 a.m. to 9:30 a.m. Eastern Time. This part of the overnight session is notable for its significant liquidity and directional activity. As London, Frankfurt, and Paris markets open, the European participants influence the market with real volume and conviction. The consolidation from the Deep Asian session is typically broken, often signaling a decisive move and trend for the morning. During this window, you can immediately look for trades at 3 a.m. because the market already has context and established levels like the overnight POC and the Asian high-low.
If London breaks and holds above the overnight POC, adopt a bullish bias. If below, opt for bearish strategies. Remember, this session is all about directional movement rather than rotation. With clear structural levels respected, this window offers A-grade setups comparable to those during New York hours. It's crucial to focus on the specific windows where high-quality opportunities exist, maximizing efficiency and protecting your capital. Soon, we'll shift to auction market theory, exploring balance and imbalance in market states to further hone your tactical approach.
Okay, guys, so real quick, this is how it would look like when you click on the link for the Reddit page that you guys can look at the trading rules. Now, for this example, I will not be using the weekly previous week's levels, only because it seems to be a lot sometimes, so I don't want to confuse you guys or make it even more difficult to understand. You guys should already know how to use these levels anyways, considering everything that I have taught you. So to make it easier for you guys, I'm only going to stick with the RTH levels and then the prior overnight session levels. And so here in this example, I have all of it marked out. So here are the overnight levels and the previous day's levels here. So real quick, I'm going to show you two different things, maybe even more. So as you guys can see here, and let me just turn on this for this session here. So normally, all I like to usually trade is from 6 p.m. all the way up till 8 o'clock. I don't like trading any later than that. You guys can trade longer than that if you want. And remember, guys, nothing is set in stone, okay? Remember that. Nothing is set in stone. You can backtest any other type of strategy that you want. It's up to you guys. So, again, I have all my levels marked up. And so, real quick, what we can see for now is that market has been pretty bullish, and then it's starting to range a little bit, and we're still moving towards the upside. Plus, we are also respecting the overnight levels or overnight sessions levels, and we do have again the previous day's levels marked up, but price seems to be range bounding in these levels for now. Again, still pretty bullish. Okay, and we're still on the 1 minute time frame. So you draw the developing profile from 6 p.m. to whatever time it is that you are currently at. So let me actually back up a little bit here. And as you guys can see, price has been chopping a good bit, especially when it comes to this Asia session or the overnight session. So remember, guys, you got to be in and out, in and out, in and out, in and out. So let's see, let's let it develop. And you guys don't have to use the developing profile levels if you don't want to. You can just remove those and, you know, just trade according to what levels you see here. It's up to you guys. So here I see prices rejecting off the previous day's value area high. Even though we are in between the overnight's value area low, you can see that it's rejecting pretty well off of the current developing point of control. So what you guys can do is enter into a quick scalp from here, right there like this. Target this little high right here. That gives us like a 1.19. So we'll let price play out. Haven't got stopped out yet. Bam. Easy little quick scalp, right? Easy, easy, easy. Now, if you guys don't want to use the developing profile, you guys don't have to. So I still have the session being highlighted right now with the kill zone. And what you guys can do is just trade straight price action. So the more time goes by, the more the Asian session traders start coming in and pushing in the volume here. So you guys can wait a little longer depending how much you're willing to wait. And real quick, you'll see price tap into this gap right here, right? And what did it do? It rejected strongly. As you guys can see, we also have this fair value gap here that got inverted. Now, again, guys, I cherry pick all my examples just to show you guys and illustrate how to use these concepts, these methods. Obviously, it's never going to be this perfect, but I just wanted to throw that out because I know a lot of you guys have this high expectation on it being like super, super perfect down to the T. It's not always going to be like that. So remember, guys, I'm always going to do my best to give you the best examples as possible, so that way you guys can get these methods ingrained in your head. Okay, so anyways, you guys see that this level was essentially respected. Even though price did not break through it, it kind of faded out a little bit and then came back in. And then here you can see that this whole gap got inverted, plus we see this candle over here, strong bullish candle. You guys could enter there. And stop loss could be either here or right here where that gap is. I'll just put it where that gap is at. Now remember, guys, the longer your or further away your TP is, the more dangerous it could be in terms of it not getting hit or getting stopped out before it gets hit. So it's up to you guys. So real quick, just for fun, I'm going to put it right here, and then we're just going to let price play out and do its thing. Bam. Right, take profit. Right, real nice, real easy. But again, guys, it's not always going to be like this, so just back test as much as you can. Leave your comments, questions down below. And yeah, guys, check the description. All right, check the description. Have a bunch of links to a bunch of different backtesting softwares, charting platforms, brokers that I use, all that good stuff.
Now we're transitioning into auction market theory in practice, which is the conceptual foundation that underlies everything we've been teaching you about volume profile trading. If you understand these two fundamental market states, balance and imbalance, you'll have a mental framework that transforms how you read charts, interpret volume profiles, and make trading decisions in real time. Before we dive in, I want to emphasize something important. What I'm about to share is how I've personally interpreted and applied auction market theory after years of trading volume profiles. This is not the only way to think about market states, and it's certainly not set in stone. Auction market theory itself has various interpretations, and different traders apply it differently. I strongly encourage you to explore the core concepts yourself, backtest how these states appear in your specific markets and timeframes, and adapt the framework to fit your trading style and risk tolerance. The goal here is to give you a mental model that works, not a rigid rulebook. The core principle of auction market theory is simple but profound. The market operates as a continuous auction, constantly searching for fair value. When the market finds a price range where both buyers and sellers are willing to transact in roughly equal volume, it settles into equilibrium. When the market determines that current prices are too high or too low, meaning one side overwhelms the other, it moves directionally in search of a new equilibrium. This alternation between equilibrium and directional movement is what defines the two market states we're about to explore. Your job as a volume profile trader is to recognize which state the market is currently in and adjust your tactical approach accordingly. If you try to fade extremes during a strong directional move, you'll get steamrolled. If you try to trade breakouts during a balanced range, you'll get chopped up by reversals. But when you correctly identify the state and apply the appropriate strategy, your edge becomes clear and your profitability improves dramatically. Let's start with the balance state, also known as fair value or equilibrium. This is the state where the market has found an acceptable price range, and both buyers and sellers are comfortable transacting within it. Price rotates within the value area, oscillating between the value area high and the value area low, with the POC acting as the central magnet. Think of it like a pendulum swinging back and forth within a defined range. It tests the edges, gets rejected, and returns to the center. Here's the key characteristic of balance. The value area remains stable, and the POC stays sticky in one area.
When you refresh your volume profile every 15 or 30 minutes throughout a balanced session, you'll notice that the VAH and VAL aren't shifting dramatically higher or lower. They might adjust a few ticks here and there, but the overall range stays consistent. Similarly, the POC, the price level with the highest traded volume, remains fixed or very close to the same level. This persistence tells you that participants have agreed on a fair value center, and the market is content to rotate around it. Another visual clue is high-volume node clustering. When you look at the volume profile histogram, you'll see multiple HVNs, areas of high traded volume, forming clusters within the value area. These clusters indicate repeated acceptance. Price visited these levels multiple times, and participants actively transacted there. The histogram looks thick and consolidated, rather than thin and sparse. The tactical implication of balance is critical. The VAH and VAL act as firm boundaries. In this state, these levels aren't just suggestions, they're walls. When price pushes up near the VAH, sellers step in, provide resistance, and push price back down toward the POC or VAL. When price drops near the VAL, buyers step in, provide support, and push price back up toward the POC or VAH. This creates the rhythmic rotation I mentioned earlier, the pendulum effect. Your trading strategy in balance is to fade the edges. This is classic mean reversion trading. When price extends to the VAH, you look for rejection signals, perhaps a strong wick, an engulfing reversal candle, or simply a failure to hold above the level, and you take short positions targeting the POC or the opposite edge at the VAL. When price drops to the VAL, you look for acceptance signals, a bullish candle close, buyers stepping in with volume, and you take long positions targeting the POC or the VAH. The POC acts as your primary target because it's the magnet, the area of maximum volume where price naturally wants to return during balanced conditions. This fade the edges approach works beautifully in balance because you have defined boundaries and a high probability that price will revert to the center. You're not predicting the future, you're simply trading the established rhythm of the market. The market is telling you, I'm comfortable in this range, and you are profiting from the rotations within that range.
Auction Market Theory in Practice, Part 2. Now, let's delve into the imbalance state, also known as price discovery or trending behavior. In this state, the market determines that current prices are not fair value, leading one side, buyers or sellers, to overwhelm the other. Directional movement occurs as the market searches for a new area where transactions can take place freely. Key characteristics during imbalance include a shifting value area and migrating point of control. Unlike in balance, during imbalance, each successive value area moves higher or lower as the market discovers new fair value zones. When observing a chart with multiple volume profile overlays during an imbalance period, you'll notice a staircase pattern of points of control, each one higher or lower than the previous. This pattern indicates that the market is actively seeking new equilibrium points. Another clue is the formation of low-volume nodes, which appear as price quickly passes through certain areas, searching for new value. These nodes showcase where very little trading occurred. They are the imprints of imbalance, marking zones where the market rapidly moves onto another area. The implications for trading during imbalance are different from those during balance. During imbalance, the old value area high and value area low boundaries lose their significance. Instead of reversing to previous ranges, price holds beyond broken levels, establishing new higher or lower value areas. Your strategy should be to trade with the move, embracing momentum and trend-following tactics rather than fading the extremes. By doing so, you align with the market's intent, riding price discovery waves rather than fighting them. Remember the phrase, "Don't fade a freight train." Respect the momentum when the market is trending with conviction. Wait for signs of balance reestablishment before shifting tactics.
Auction market theory provides a mental model for understanding market behavior, helping you distinguish between equilibrium and price discovery and adjust your playbook accordingly. Next, we'll explore how to identify market state using volume profile clues to recognize balance versus imbalance instantly and make the right tactical decision in real time. Now we're diving into one of the most critical skills in volume profile trading: identifying market state. This is the skill that separates consistently profitable traders from those who struggle. Understanding whether the market is in balance or imbalance determines your entire tactical approach, whether you should fade the extremes or trade with directional momentum. Before we dive in, I want to emphasize something important. What I'm about to share reflects my personal experience. This is not the only way to approach market state identification, and it's certainly not set in stone. I strongly encourage you to explore these concepts, backtest them with your own data, and adapt the framework to fit your trading style, risk tolerance, and the specific markets you trade. What works for me might need tweaking for you, and that's perfectly fine. The goal is to give you a mental model that works, not a rigid rulebook. This concept comes directly from auction market theory, which describes how markets operate as continuous auctions searching for fair value. When the market finds fair value, it rotates in balance. When it discovers that current prices are too high or too low, it moves directionally in imbalance, seeking new areas of value. Your job as a volume profile trader is to recognize which state the market is in and adjust your strategy accordingly. Let's start with the balance state, also known as fair value or equilibrium. This is when the market has found an acceptable price range where buyers and sellers are in equilibrium. Price rotates within the value area, oscillating between the value area high and value area low, with the point of control acting as a central magnet. Here are the 4 key clues that tell you the market is in balance. Clue number 1, value area stability. When you look at your volume profile over multiple time periods, say the last 3 or 4 hours, you'll notice that the value area remains in a similar price range. It's not shifting dramatically higher or lower. The VAH might move a few ticks up or down, and the VAL might adjust slightly, but the overall range stays consistent. This tells you that participants have agreed on a fair price zone, and the market is content to trade within it. Clue number 2, POC stickiness. The point of control, the price level with the highest traded volume, stays relatively fixed. It's not migrating up or down significantly. When you refresh your volume profile every 15 or 30 minutes, you'll see the POC remains at or very near the same price level. This persistence tells you that the maximum acceptance, the price where the most trading activity occurred, hasn't changed. The market keeps coming back to this level, confirming it as the center of value. Clue number 3, high volume node clustering. When you examine the volume profile histogram, you'll see multiple HVNs, areas of high traded volume, forming clusters within the value area. These clusters show that price has repeatedly visited these levels, and participants have accepted them as fair. The volume profile looks thick and consolidated, with several prominent humps rather than a single spike. This clustering indicates that the market is distributing trades across a range, rather than racing through it. Clue number 4, price rotation between boundaries. This is the most visual and obvious clue. You can literally watch price bounce between the VAH and VAL repeatedly. Price pushes up to the VAH, gets rejected, drops back toward the POC or VAL. Then it bounces at the VAL, pushes back up toward the POC or VAH, gets rejected again, and the cycle continues. This rhythmic oscillation is the hallmark of balance. The market is testing the edges, finding sellers at the top and buyers at the bottom, and rotating within the established range. When you see this pattern, multiple touches at both the VAH and VAL with clear reversals, you know with high confidence that the market is in balance. Each rejection at the boundaries reinforces the strength of the range. So what's your trading strategy and balance? It's simple. Fade the edges. This is mean reversion trading. When price pushes up to the VAH, you look for rejection signals to take short positions, targeting the POC or the opposite edge at the VAL. When price drops near the VAL, you look for acceptance signals to take long positions, targeting the POC or the VAH. The POC acts as your primary target in most cases because it's the magnet, the area of maximum volume where price naturally wants to return during balance conditions. This fade the edges approach works beautifully in balanced conditions because you have defined boundaries and a high probability that price will revert to the center. You're not trying to predict breakouts or catch trends. You're simply trading the established rhythm of the market.
Now let's shift to the imbalance state, also known as price discovery or trending behavior. This is when the market has determined that current prices are not fair value, and it's actively searching for a new equilibrium. Price moves directionally, up or down, breaking through previous boundaries and establishing new value areas. This is trending behavior, and it requires a completely different tactical approach. Here are the 4 key clues that tell you the market is in imbalance. Clue number 1, value area shifting. When you compare volume profiles over time, you'll notice that the value area is consistently moving in one direction. If the market is in bullish imbalance, each successive value area is higher than the previous one. If bearish imbalance, each value area is lower. The VAH and VAL are not staying in the same price range. They're migrating with price as the market discovers new fair value zones. Clue number 2, POC migration. The point of control is not sticky, it's traveling with price. As the market moves higher or lower, the POC shifts to new price levels, reflecting where the new maximum acceptance is occurring. When you look at a chart with multiple volume profile overlays, you'll see a series of POCs forming a staircase pattern, each one higher or lower than the previous, rather than clustering in one area. Clue number 3, low volume node formation. As price moves quickly through certain areas in search of new value, it leaves behind LVNs, thin sections in the volume profile where very little trading occurred. These LVNs form gaps or valleys in the histogram, showing that price raced through these levels without finding acceptance. Participants weren't interested in trading at those prices. They wanted to get to higher or lower levels quickly. LVNs are the footprints of imbalance. Clue number 4, breaks and holds beyond boundaries. Price doesn't just test the VAH or VAL in reverse, it breaks through decisively and holds beyond those previous boundaries. When the market is in imbalance, the old value area boundaries lose their significance. A VAH that would normally act as resistance in balance gets broken and left behind as price establishes a new, higher value area. The break is clean, the hold is sustained, and there's no immediate reversion back into the old range. So what's your trading strategy in imbalance? It's the exact opposite of balance. Trade with the move. This is momentum and trend following. You're not fading the extremes. That's fighting the freight train, and you will get run over. Instead, you follow the directional momentum. You use pullbacks to broken levels as continuation entry opportunities. If the market is in bullish imbalance and price pulls back to a broken VAH or POC that now acts as support, that's your entry to go long and ride the trend higher. This trade with the move approach aligns you with the market's intention. You're not trying to pick tops or bottoms, you're riding the wave of price discovery as the market searches for new equilibrium. Here's the key principle that ties this all together. Strategy follows state. In balance, fade the extremes. You're a mean reversion trader targeting the POC from the edges.
In imbalance, don't fight the freight train. You're a momentum trader, using pullbacks to rejoin the directional move. This is not about being bullish or bearish, it's about being adaptive. The market tells you its state through volume profile clues, and you adjust your tactics accordingly. The biggest mistake traders make is using the wrong strategy for the state. Fading extremes in imbalance gets you steamrolled. Trying to catch trends in balance gets you chopped up by repeated reversals. But when you correctly identify the state and apply the appropriate strategy, your win rate and risk-reward improve dramatically.
Today, we'll focus on your homework assignment, crucial for honing your pattern recognition skills in trading. You have two tasks, one for balance and one for imbalance. Task number 1. Find a balance example. Go through your charts from the past week to find a clear 2 to 3 hour period where the market was in balance. Here's your checklist. First, locate a stable value area. The VAH and VAL should remain in a similar price range over this period, not shifting dramatically. Second, verify POC stickiness. The point of control should stay within a narrow range throughout the entire period. Third, mark at least 2 complete rotations where price moved from the VAH down to the VAL or from the VAL up to the VAH. You need to see this ping-pong behavior clearly. Finally, take a screenshot of your chart with the value area drawn, the POC marked, and arrows showing the rotation pattern. Label this screenshot Balance Example and save it to your trading journal. Task number 2. Find an imbalance example. Now, locate a clear trending period where the market was in imbalance. Here's your checklist. First, find a trend where the value area shifted at least 3 times in the same direction. Each successive value area should be noticeably higher or lower than the previous one. Second, identify the POC migration pattern, a staircase effect, where each successive POC is higher or lower than the previous one, not clustering in the same area. Third, locate the low volume nodes that were left behind. These are thin gaps in the volume profile histogram where price raced through without acceptance. Mark these LVNs on your chart. Finally, take a screenshot showing the shifting value areas, the migrating POCs, and the LVN gaps. Label this screenshot Imbalance Example and save it to your journal. Why does this homework matter? Because recognizing balance versus imbalance in real time is a discretionary skill that can only be developed through repeated exposure to historical examples. When you search for these patterns in your past data, you're training your brain to instantly recognize them when they're developing live. This is not theoretical knowledge, it's pattern recognition that translates directly into trading decisions. Here's your action item. Complete both tasks. Find one clear balance example and one clear imbalance example. Annotate both with clear labels marking the value area boundaries, the POC, and the key characteristics. Write a brief note explaining what clues confirmed the state. Save these screenshots to a folder labeled Market State Examples. Review these examples daily for a week. Then, as you continue trading, add new examples every week. Over time, you'll build a library of examples, a mental reference database that helps you recognize states instantly. This pattern recognition ability is what separates professional discretionary traders from struggling beginners. It's not a mechanical rule you can program into an algorithm. It's a learned skill that comes from repeated exposure and deliberate practice. Once developed, your trading transforms. You stop fighting the market and start flowing with it. Next, we'll dive deeper into how levels react differently in balance versus imbalance and why the same volume profile level can act as strong support or resistance in one state, but get completely ignored in another.